Hi, everyone, and welcome into a new venture here that we are starting and hope you'll enjoy and get something out of and won't think that it sucks. This is called More Than Mortgage. I'm Chad Anderson. This is Zach Jones. Hopefully, you know some of us or know both of us. If not, then we've done a bad job on branding ourselves and getting out in the community. But basically, we always, Zach and I, enjoy bantering a little bit, both good, bad, and the ugly on mortgage topics, real estate topics, things on social media, things with clients. We all have war stories. We all have that partner or that client or that situation. We all have that. So we wanted this show to be a little bit about weekly content and what's happening in the world. A lot of times, reels, Facebook posts, etc. They're just quick fly by night, grab it for 10 seconds, and they don't always tell the entire story. So we wanted to have a little bit of a longer form platform or medium to where we could actually discuss and dive into some of these issues or topics or whatever it may be that require longer than a 45-second attention span while you're scrolling through TikTok or Instagram. So that's what this is. We hope you'll join us. We hope you'll like and subscribe on each of our YouTube channels or follow us on Facebook, Instagram. Our information is right there at the bottom of the screen. Zach, welcome. How are you?
I'm good this morning, Chad. Excited
Yeah.
about this adventure. And listen, I'll just add a little bit to that. If there's anything that you want to hear about specifically and hear some commentary on, we'll be happy to dig into that. And we're going to pay attention to the feedback that we get from our audience and try to make it relevant, try to keep it relevant.
Absolutely. Yeah, that's a great point. Load up the comment section because we don't want to sit here and babble about something you don't care about. That's where shows go to die. So we would rather be more interactive, talk about things that you're interested in, and not just stuff that we want to chat about. We could do that over the phone or in the office. We want to know what you guys want to hear and listen about, and opinions and so forth. So anything's open. I'm not afraid to have a hot take. I don't think Zach is either. So if you've got something, I'll tell you exactly what I think. I know Zach likes to do that as well. So myself, I've been in the industry 13 years now. We both work at Modern Lending, which is a local brokerage in Franklin, Tennessee. I used to actually be in real estate for a very short time. I got in right as the crash happened in 2007. So it was perfect
Mhm.
timing for myself. Yeah, I went from broke to more broke. And but we've been fortunate enough to have a successful mortgage career, very blessed to have that. And enjoy doing some of these things because I also have a broadcasting background with the sports side, talk shows and play by play and whatnot. So I enjoy it. I'm a nerd. I like Airbnbs, rental real estate, investment properties, mortgages, all those things. So I hope that helps least a little bit with some credibility, and enjoy getting an opportunity to hang out with you guys. So, Zach, your background, sir.
Yeah, real quick, 20 years in the mortgage business. Actually, this year I've worked broker, I've worked banker, I've worked retail loan officer, back to broker. A lot of background there, and bought my first house at 21 years old or something ridiculous, and have owned a lot of real estate since then. Do investment real estate, short-term rentals. Have all of that background. Chad and I have done a lot of correspondence or coordinating back and forth and comparing notes, and we're both pretty heavily invested in real estate. So, there's some background and some substance to what we have to say, and there's a lot of, I don't know. I think that maybe one of the greatest values that we bring is an analytical perspective to the market, and we try to not to be reactive to what's going on, to be thoughtful about everything that we see facing the industry right now and the
Yep.
market and moving forward. And so in my heart, I'm a real believer in real estate as an investment and as a kind of a foundation to our cultural life in America. I don't know what it's like anywhere else because I haven't ever lived anywhere else, but I'm a real believer in it. So that's kind of where my passion starts. And hopefully we can maybe bring a little bit of comedy to this and a little bit of irreverence to the subject as well, because neither one of us is short on opinions. So hopefully we'll have a little fun doing this too.
No, we've known to have our soapbox moments here and there, but
Yeah, yeah,
you mentioned that with real estate in other countries. I'm not an expert on that either. I don't know if I should be ashamed to admit that or not, but I just don't know. I did travel to Europe this past summer, and while I was in Florence, I was asking a couple of people, "Hey, what does that apartment run?"
right,
And we're talking these are like built in the 1600s,
right.
overlooking the river, but there's no central AC, so the windows are all open. It's kind of unique, and I think if I remember correctly, they were saying in American dollars, 900,000 to a million, something like that.
Yeah.
But we're talking about a shoebox apartment, like a New York City style apartment overlooking the river there. But one thing is, America seems to be the most aggressive when it comes to lending money. Like everyone in Italy was, 20% down, 25%
Yeah.
down, 30% down. Like in America, you think about it, and this wasn't actually our first topic, but just on a quick note, that's kind of interesting, right? Like, where else can you go buy an asset this large and only put as little as 3% skin in the game, while the bank takes the 97% risk? Or some programs you can do 100% financing, such as USDA or VA or down payment assistance. It's kind of unique, like that America for this long has had the real estate market done like this, where and I know it hasn't been the entire time, but to be that aggressive in making sure people get into houses.
Well, it is an interesting point, and maybe my first thought about that is we're probably the most aggressive capitalist society,
Yeah.
as in the top 10 of
Mhm.
largest producing countries in the world, or major countries, maybe superpowers, certainly the most capitalistic. All of that's really interesting. I had a French client one time who came in literally fresh off the plane, didn't have a social security number, didn't have a bank account, didn't even have a place to stay yet.
Wow.
And we were able to, it was one of the most interesting and complicated loans I've ever done, but we closed on a house within 60 days of the plane touching the ground for that client. And
Wow.
um, very interesting process, but the French system doesn't have credit reporting. So what you do is you establish a relationship with a bank, and then you do all of your banking, all of your financing, every bit of that relationship goes through that bank, and occasionally you go outside of that bank to secure financing, possibly on an automobile. I remember this credit profile had one non-bank, or it didn't even have a credit profile. I mean, we just were making it up, but he had one account that
You're
existed
trying to
out.
piece together non-traditional credit
That's right.
is all you're
That's
saying. Yeah.
exactly right. And we had to get that payment history, but um, he had one account that was not with this particular bank, that was in this particular small town that he lived in, on the border between France and Switzerland, and it was with Volkswagen Credit. It was for his automobile. So it's very different, just very different doing business in other countries. So uh, mm, diversion. We didn't get started on this podcast for 5 minutes before we got diverted onto a
I
subject
know.
that we were going
Yeah.
to talk about. Yeah,
If we have squirrel moments, we apologize. Okay.
yeah.
It just
There
is
we
what
go.
it is. All right, let's get into the hot topic, which came out a couple of weeks ago, early, what was it? Late October, early November. And that, of course, is the lawsuit, the antitrust suits that took place in Missouri and Texas with NAR, National Association of Realtors. Also, just brokerages in general. Zillow, I think Remax was mentioned in that, or maybe they settled beforehand.
Yeah.
Maybe Keller Williams. I don't want to misspeak, so if I and name somebody that's not, because I don't have it right in front of me. But that was the deal that came out, and there's been a lot of talk around it. There was about, I would say, Zach, and this is why I wanted to talk about it today, is let the dust settle for a moment, because You have your knee
Number
jerk
one.
reactions. Yeah,
Yep.
you have your freak out moments, and you got some agents who are, "Oh my god, we're going to go hungry. I got to find something else to do." You got other agents who say, "I don't care. I'm a listing agent. This isn't going to really impact me that much." You got other agents who kind of just discard it and say it's not that big of a deal. We'll get through it. I would say that no matter which side you're on in belief and what you think with this, the real estate market and the real estate industry is one that really has not been disrupted in an extremely long time,
Right.
really long time. And you've seen people try, you've seen the flat fee brokerages, you've seen open door, offer pad, some of these different groups, right? They try to get in, find their niche and, get their share of the pie, but nothing ever trumps the local person who just continues to door knock or be on social media or be in the community or whatever the case may be.
Even
So
Zillow, the big monster,
the behemoth,
hasn't has not disrupted the industry. They've made a huge impact,
yeah,
but there's not been a disruption, what
no,
we consider a disruption.
correct. So this is interesting with the lawsuits because there will be appeals. There will also be though other cases that will come from this, and we're already seeing that. Um, let's just start with initial reaction. What you thought of this. Is it justified? Is it something that people truly do have to worry about? Is it going to be a little disruption? Is this going to be an overhaul? Just kind of initial reaction on this.
Well, so let me tell you about my bias first. I have a bias about attorneys and the legal system. To say that there is justice is probably a gross overstatement, at least in my estimation. There's not really a whole lot that's fair about the legal system. And when you get into class action lawsuits, my honest opinion is that the people who win that are the attorneys. And so it's always going to be in the legal system's best
Aaron
interest.
Brockovich, right?
Right. I mean, there's not any way that when you have somebody who is generating billable hours that they're not going to win, and the whole system is set up that way. So that's kind of my foundational bias. So the net result of this, I think, is going to be that the attorneys are going to win. They're going to get the biggest piece of the pie. Consumers who were somehow wronged by the industry about forced commissions and price fixing and all of that stuff, not really, there's not really going to be a benefit, but that's not going to stop people from joining the open classes. And so, if somebody wants to join an open class and get a check for 117 bucks, that'll help them buy their groceries this week. And who cares, because it's the big corporations that have to pay it. Well, it's going to impact the industry, I believe, in some significant ways, but we don't know what those are yet, because the blood is in the water right now, and we haven't kind of seen how that's going to play out. The precedent legally that's been set is that the defendants have been found guilty, and there, because of that, there will and the copycat lawsuits, which we've already seen, man. The second lawsuit came 30 minutes after the decision on the guilty verdict, and we've
They
seen
were
some.
just waiting. They were
There,
waiting. They
well,
were waiting to click send.
it was completely all filed. Yeah, they're sitting on the send button, and we've seen. I know, and I don't follow this, super closely, because it's not my business per se, but it certainly affects what we're doing.
Sure.
There's been a big class that was filed in Texas as a subsequent follow up, and there's a lot of what I would perceive as probably smaller. They're not the major names. The major names are in there, but they're smaller, and maybe even some mom and pop shops, that's concerning, because those companies don't have the deep pockets to defend themselves. And so I think that the biggest, like you said, Chad, the biggest thing that agents and brokers have to do is take a deep breath and prepare themselves, brace. And then I think there's some forward thinking that needs to be done. You need to understand legally where your protections are with immunity, So if you're a member of NAR, the biggest piece would obviously be NAR members.
Yeah.
And as I understand it, if you're a member of NAR and NAR responds to all of this with a settlement, then the settlement, they open the class, everybody jumps into the lawsuit. NAR creates a settlement agreement, satisfies that settlement agreement, and then all of the NAR members enjoy an immunity. And this is at its simplest form. I'm not an attorney, but those NAR members then enjoy the immunity from further suits because the NAR has settled it on their behalf. And maybe that happens at your brokerage. Maybe if you're a Keller agent or you're a United agent or whoever it is that you work with, they enter into a settlement agreement, and then you're protected, and you no longer have to worry about it. That seems to be the most important thing. If I were an agent, I would want that immunity protection of being a part of a settlement that has been settled. And now I no longer have to worry about it moving forward. It would be if I weren't a member of an organization that settled, then I would continue to kind of feel this nagging annoyance that I was going to somehow be named at some point in the future, and I might not have good representation to protect myself.
Yep.
That's the greatest concern. And, the tracking is there. That the attorneys, in my opinion, will go after the money as long as there's money there. And when the money exhausts itself, I mean, think about the mesothelioma lawyers and the Roundup lawyers and all of the Paris Island water supply lawyers. How many Marines are there? That you can go after and try to settle suits on behalf of Marines who attended boot camp at Paris Island.
Yep.
There's a whole lot more realtors in the last 20 years than there were Marine recruits that went to Paris Island. So I think that the pool is deep, the blood is in the water, and this is not going to go away because there's a lot of money to be made by the legal system. So that's my number one response is like you said, Chad, take a breather and don't do anything rash. It's very tempting to fall prey to the screw NAR, I'm out of here, or the guy who is the Instagram post that went so viral, the guy who is getting his torches and his pitchforks out, wanting to countersue the American Bar Association because they are also price fixing. That sounds real good, but it's kind of dumb. I mean, if NAR wanted to go after the American Bar Association in a class action lawsuit, the bar would say, okay, we'll do that because it's more money for them. It's
Sure
just
it is.
more money. They can churn billable hours and get half of their membership to represent NAR because NAR's got to sue the attorneys with attorneys.
Well, the other funny part is that NAR is the leading lobbyist in Washington.
By
They
far.
they spend more money than any other lobbyist in the entire country in Washington. So just an
So
interesting little nugget there to throw in as
the
well.
I want to know if the audience really understands this because I did not know this until about 2 weeks ago. And I saw a graphic on a website called Open Secret, which is one of the things that they do is they track lobbying activity. And the National Association of Realtors is the number one spender of money in lobbying efforts. It's not the Bankers Association. It's not the industrial defense contractors. I mean, there's so many things that I would have thought would have been stronger lobbying organizations. Number one, most money spent by any industry, by any single lobbyist, National Association of Realtors.
And
Huge.
and the funny part is, which one would you say is the most controversial when it comes to lobbying? Like I have two in mind
Uh,
without even looking at the graph or the data. I
I,
have
I
two in
would,
mind.
I just cited banking and defense contractors. Those are the two that I would designate. You might change my mind with your idea.
The two I would think of, like if you just walked up to somebody on the street and they understood what lobbying was, and they said, "Hey, what do you think are the two biggest lobbyists in Washington?" The first one I would have said is pharmaceutical.
Okay.
Like I would have said that number
Yep.
one,
Top
hands
three.
down.
Yep. Yep.
Number two, I would have said the NRA. So,
Mhm. Yeah.
uh,
National
because
Rifle Association. Right.
yeah,
Right.
because it's just such a controversial topic across the country that to me, anything that's controversial costs more money to keep in place. Like that would be my logic from it. So
Correct.
therefore, if those two are the most controversial, and it doesn't matter which side you're on, it's a fact that pharmaceuticals and gun control are two of the leading controversial decisions in this country. You are very divided on those because of COVID and
Right.
because of just the tragic, gun control issue in certain situations that we have, and the argument of nobody should own an AR-15, but I don't want you to take my revolver away, kind of thing.
Well,
So,
take just to add to that, I think that the pharmaceutical industry is far richer than the firearm
oh,
industry.
it's not close.
Like
It's not
not even
close.
close. So yeah, far and away.
Yeah,
Uh,
not
I mean,
close.
yeah, yeah. So I brought the graphic up, Chad, and just while we're on this topic, the second largest is the U.S. Chamber of Commerce. So
Hmm,
the Chamber
that's
of
interesting.
Commerce spends almost as much money as the National Association of Realtors, and then the third in line is your
There you go. And I
pharmaceutical
didn't know,
industry.
like, I guess but it makes sense, right? It's just so controversial, especially after COVID.
Right.
Especially after COVID. It's so controversial.
And the spread between National Association of Realtors and Chamber of Commerce pharmaceutical. It's a
Mm,
third of the top
wow.
two, a
Wow.
third. And then the Hospital Association, Blue Cross Blue Shield specifically, Facebook,
That
American Medical Association, Amazon, Business Roundtable, and Comcast. Those are like
and
the top 10.
what'd you label there? 4? Was it 4 or 5 that have to do with the medical industry?
Yes.
Between
Yep. Yep.
pharmaceutical,
Yep.
insurance,
Insurance.
hospitals?
Right.
Yeah.
Right. Right. Yeah. It's
Half in this
very
country.
interesting. Very
Half.
interesting.
Yeah.
But you might be able to put all that together and still say that if there's five medical sources that spend all this money on lobbying and they're in the top 10, they still might
Mhm.
not spend as much money as NAR does.
It's true. Yeah.
It's fascinating when you look at it from that perspective.
So here are a couple of quick takes from my perspective on this, and then we've got a couple of other topics to hit on today. But for me, this is almost a moot point until it becomes a seller's market again. Because in a buyer's market, which we are sitting in as of today, where sellers are not getting 10 offers on a home, you don't have a half-mile line of people down the sidewalk for an open house. You don't have those things right now. I think that those are coming back, but we can get into that here in just a minute. But in a seller's market, that's when the struggle is going to arise of how much commission is being paid out and to who. That's where it's going to come into play
Then the
because
sellers have a decision to make, right? Because they're in the
yeah,
catbird seat again. Right.
again, yes. So if you sit here and look at it, and that's where the concern is a little bit for me is you have buyers who are now potentially even more overpaying for a home because they may not have a realtor to say, I know you love this home, but you can't pay this much over asking for it. Like that's absurd.
Right.
Somebody else might, but you don't want to be that one that's caught. But then again, you may lose some negotiation power. Like you may miss something that gets you the house that you didn't think of, but a realtor would have. On the flip side, you could save money. If you don't have the money to pay an agent, you may have to roll the dice, but it could end up being a costly roll.
Right.
If you miss something, it's really going to be a difficult decision for buyers because whatever they pay their buyer agent, because in a seller's market, the seller's not going to be paying it, in my opinion. That's where you're going to see the struggle. That's the bigger concern, and I guess that's not taking place right now. So I'm not worried in general about it, because we're 6 months, a year, 2 years away from another seller's market coming back whenever rates go back down. So right now, it's just not a big deal, but it will become one, in my
This is
opinion.
fourth quarter of 2023 that we're talking about this perspective on rates.
Correct. Yeah. So that's to me, and it's going to be one of those things like who falls first, like who gives in first, and who puts their foot down first. Which seller or which market puts their foot down first and says, "I'm not paying the buyer's agent.
Right.
Good
Right.
luck. But come
So
on,
here,
still bring the offers."
let me tie this back into National Association of Realtors, and don't take any of this commentary as if I'm a fan of NAR. NAR is very easy, gives lots of reasons to be to be criticized,
Yeah.
but they hold a tremendous amount of power based on this discussion that we just had about lobbying dollars. They've
Mhm.
got a huge presence in Washington, and we don't, as mortgage guys, we got nothing. The Mortgage
They
Bankers
laugh at us.
Association is absolutely laughable from that lobbying perspective. And that's why we're so heavily regulated by the government, is because we got no representation. We just say thank you, sir, may have another, and they keep hammering us.
Yeah.
So NAR, for all of its faults, really does have a lot of power in that. And what Chad's talking about is when this thing turns, we don't have the urgency about who's going to pay it now. But when this thing turns, it's going to get real serious real quick.
Yeah.
And one of the things that NAR can do because of their influence in Washington is they can lobby to Fannie and Freddie, the conventional lenders, and specifically also to VA and FHA is in there as a lesser player, maybe not as I'm thinking through that, but they can lobby to the GSEs and the VA to potentially allow for financing of a buyer's agent commission into the loan. So I think that that's a critical piece of this for first time buyers. If you're a step up buyer, you're coming in with equity, you can pay your own commissions and negotiate that out. But especially to keep that first time entry level buyer viable, they're
Yep.
going to have to be able to borrow that money from somewhere, because there's going to be a point in the market where sellers say, I'm not interested in paying anything. You're on your own. We've already seen that. We saw that through the pandemic, and sellers say, we ain't paying nothing, man, because we don't have to.
And Zach,
So,
the the first time home buyer already a lot of times has a hard enough time getting offers accepted because of the programs they
right,
go with.
right.
Not even about the buyer commission, just the programs in general.
Or
Nobody
just the
wants an
percentage of
FHA.
down payment.
Nobody, yeah,
People like
nobody
it.
wants an FHA deal when you get a
Right,
pre-approval letter. Nobody wants to see 97% loan to value. Those kinds of things sellers don't want to see. So they already have a struggle. Now, like you said, they got to come up with extra funds. And you're right. The decision that somebody with a step up uh, purchaser may be up against is, oh, well, I only have enough for 20% down. So if I pay an agent, I may only be able to do, 17 or 18% down, which means I now may have PMI and it's $50 a month. Like that's the struggle they're going to run into.
right.
The first time home buyer is going to run into, I don't have cash and I can't pay over the price of the house either. A
They're
step
not
up person
competitive.
can. Yeah, a step up person can. They
Yeah,
they can go from 20% down to 10% down because they could use that 10% gap in the middle there to pay for a buyer's agent, to
right.
pay for upfront MI, to pay for an appraisal gap, whatever the case may be, to pay for repairs that a seller is not willing to pay for because they don't have to sell their
Money
home.
solves problems. That cash
Correct.
solves problems. Right.
So that'll be interesting. Again, take a deep breath. I don't think it's as big of an issue right now because it's a buyer's market. But when it becomes a seller's market, we should circle back to this episode because it's going to, in my opinion, change a lot of things. We'll see. It's going to cause a lot of rubs and a lot of frustration, but we'll see what happens. I think last thought on this: if you're a buyer's agent specifically and you don't do listing and selling, you just do buying or selling, whichever one you want to call it. Um, you start to look at, and we're going to end the show later with this too, but just as a little preview, a little forecast is you have to figure out who your client is, what their true needs are, and then sell them that based on value you can provide.
Hmm.
Because not every client, I hate to tell you, and I'm this way to be honest, but I've also bought and sold 15, 20 houses over my lifetime. And I have investment properties. And that's not a flex. That's just I've been through the process. I just know kind of ins and outs and I know my blind spots. And so if you're asking me like, hey, I may not need all your services, and that's okay. Don't try to cram a full thing down my throat. If you have somebody who's green, first time home buyer, you're not trying to cram a service down their throat. You're just trying to say, like, you're going to need all this. You're going to regret it.
Full service
Full
versus
service,
somebody
full
who's
array. Yeah.
like you, who works in the industry and looks at contracts all day long.
Yeah. We
I
see
mean,
them every day.
yeah,
Right.
we've got some skills, right?
Yeah,
Yeah,
exactly. So that's where it's going to come into play. And you're going to have to work on not overselling. You're going to have to work on not trying to convince somebody. You're going to have to find the client. We do that now. And on the mortgage side,
right.
we look at clients and I tell everyone I talk to, like, I'm more here to give you the options and the things we can provide. And then I'm coming back and telling you, hey, you make the adult decision. Here's option A, B, and C. I don't care which one you choose. I'm going to make a living because we're going to do this more than just with you. But I want you to be happy. So you choose A, B, C. Which one do you want to do? And I think that's kind of the pitch and the direction that they may have to go on the buyer side as an agent,
Yeah.
because everybody's going to be a little bit different. So,
And there's going to be with that, just add to that, a new focus on the buyer agency agreement, which has been
yeah,
largely ignored. I've asked this question over the last several weeks since this came out.
it's a piece of
How
toilet paper.
what percentage of buyers agents get a signed agreement when they start showing houses? And it's a fraction of a percent. Just
Yep.
it's just been ignored. It used to be a thing, and it's just not a thing anymore, and it's going to be a thing again. So you're going to have to get really good about that initial upfront conversation about money, and what do you, in addition to how many beds and baths, and whether you want to, you need a backyard for Fido, you're going to have to talk about money.
So let's look at this other item here that I want to share. And this is something that everybody's going up against at the moment, from the loan side. And we want to use this. I want to segue from real estate side into mortgage rates, because that's the daily
Yeah.
question we get, Zach, is what are rates going to do? What do you think rates are? When are rates coming down? That's always the $1,000,000 question. So this is an advertisement, though, that was, in an article on social media, whatever the case may be. This is amazing conventional loan fixed rate 475 or up to $33,500 towards closing costs. This is for Lennar, I believe, is the
Right.
builder in this one. But down here in the fine print, they kind of tell you, hey, you have to go under contract within this 5-day window, and you have to close by the end of the year. They're trying to get rid of units. They're trying to do their thing. Publicly traded company. So they got numbers to hit. They got things that they got to do for their shareholders. Um, Here's the thing on this, folks, is that when you see this, so one, to tie it into the realtor side, is this, in your opinion, Zach, quick answer, is this something that is going to bleed over into the builder sector? Because they're offering this amazing rate and deal, and they're giving you all these closing costs, but the money is somewhere, guys. And a lot of times it's in the price of the home. So if you're a consumer, you're a lot of times financing a lot of this stuff because builders are making hand over fist on the build side. So if this is in here, like, it just poses an interesting question, because on the loan side, basically the way they're able to do this is a builder goes, I've got so much money over here on the house itself. I'm making so much money over here. I can actually take a small loss on the mortgage side, or even a significant loss on the mortgage side, because I own the mortgage company. in order to move a unit because the unit has tons and tons and tons of profit built into it. So I'm all for capitalism. Like if you want to do that, that's great and whatnot. But I just thought this is interesting because lenders and realtors are running into this a lot of times. Remember when builders were telling agents, "Hey, we don't need you. Um, we're not going to
Two
pay
years
you.
ago. Two
Yeah,
years ago.
we're not going to pay you a commission." Now all of a sudden, realtor incentives are back, and realtors are back with builders.
That's right.
But it's one of those like I don't know. You just look at it and you go, "Wow, you're offering this and you're taking a loss on one side." So then it comes, you start opening up this can of worms, like fair housing and opportunity for everyone on qualifying, and oh, you have to use our lender. You have to use our lender. You can't. We won't give you anything if you use an outside lender. The realtor commission and how that changes and ebbs and flows. So it's just we're seeing this more and more because builders are trying to uh, get out from underneath the housing compression right now as well.
I would be very surprised if there's not a big successful class action law firm that is not looking very closely at these promotions, because the real accusation and the guilty verdict is around price fixing. And this certainly smacks of price fixing. So let's be real simplistic, 10,000-foot flyover. These incentives from national builders, especially where they own their own mortgage company, is about protecting the builder's price.
Yep.
So the builders build in sequence and they bump prices up according to their build schedule. I've been privy to some builder conversations where, the conclusion was every four houses that we build, we're going to bump the price by $10,000. Every four contracts, the price goes up, that base price goes up $10,000, or take your pick, however much that is. So what's happening here is that in order to bridge the gap and not discount the prices on houses, builders have given more and more and more and more incentives. You see builders given $50,000 in our local Nashville market
Hmm.
in incentives toward closing costs and 3-2-1 buy downs and 2-1 buy downs and all kinds of, whatever, build you a fence and a storage unit in the back and epoxy floor your garage, 50 grand. Well, but they're not taking the price off of that $500,000 house down to 450. The price remains 500 because they're trying to protect their price for comps. If
Yep.
they brought it down to 450, then they've got the whole rest of the neighborhood who bought at 500 bringing the torches and pitchforks over to the model house,
Yep.
or they've got to start back over and build back up when the market turns and the consumer demand comes back as these rates come down. They would have to build back up. And so what this allows them to do, as long as they're generating sales and they're writing contracts, they can actually bump up the price of those houses moving along, even though they're given, 5 or 10% of that price back to the buyer. That's,
Yeah.
I think, where you start getting into trouble, Chad, is not in, hey, we've got, $32,000 in incentives. If that's 5 or 10% of the house, that sounds mysteriously like a big shell game that some fancy pants, clever attorney is going to be able to convince a jury that the big mean corporation is doing something nefarious. That's my concern.
And what's interesting? I have told just regular old Joe homeowner, hey, right now in this environment, don't lower the price of your home. Don't lower it $10,000.
The
Talk to
cash
me
is not
about what the rate is
right.
if you bought the rate down $10,000, because the society still has the rate shock from a year and a half or so now,
Right.
that if you would advertise like a 5.5% permanent fixed rate because you're using 10 grand
Yeah.
to buy it down, not a buy down, like a permanent, you get 5.5 for 30 years. That makes that house stand out more than this house over here, because everybody's strategy has just been, oh, it's not selling, price drop it.
Right.
Builders doing the same thing here. They're going, "Hey guys, we can't drop the house. Let's get a 475 out there."
Yeah.
So it and
Even if
by
it
the
only
way, like
lasts 12 months, even if it's just a kind of a
right.
teaser,
By the way,
people are attracted to it.
I'm all for builders doing this. Like this isn't me picking on builders because one, we work with builders and I like builders. I have no
Yeah,
problem with them. They've been very good to us. I bought some houses from our preferred builders. Like I have no issue with builders whatsoever. It's a capitalist economy.
correct.
You do what you need to do for your business to make things work. And if this works, that's fine. But the question does come up of because of what happened with NAR, just it poses the question of are they susceptible in the future to other possibilities like this? And
Whether
the
they're
most
guilty
annoying
of
thing
any
for builders is that when they won't let me do the loan because they got a preferred lender,
right, right.
that's always that's the
But
most annoying part for me.
I always add this where there's a legal process involved, whether they're doing something wrong or not. It really is the appearance and whether or not a really clever, smart attorney can make it look criminal or nefarious in some way.
Right. Yep.
We've got a society, Chad, that really likes to play the victim, and we like to have a hero and an antagonist, and so it's an easy thing to come up with. And I think this NAR lawsuit is evidence of that because there's a lot of people who are like, wait a minute, well, we didn't do anything wrong. Well, it doesn't matter. The legal system didn't find in your favor, and that's what matters.
All right, so let's get into mortgage rates. We got
Yep.
about 15 minutes here.
Okay.
So on the mortgage rate side, let's just be honest. I'll call ourselves out here. Mortgage people thought last year that rates would be back down already at this point this year. In
Correct.
fact, we thought that on May the 10th was going to be
Infamous.
the huge drop. Oh, because inflation was going to fall off the cliff. It was going to catch up to itself. All the data was going to be back to somewhat normal. And we were going to be in a spot where rates were trending back down fives, fours. Not we weren't expecting twos and threes. We were just expecting fives and fours again, and that things were going to be oh so much better. We're okay. We're good. Back to normal. Back to business. That isn't the case. In fact, they continued to climb and got
Yep.
all the way up to over 8% on a national average. So
Nobody
now,
saw that coming.
no
No,
one, no one,
there were no industry experts. So
no,
we're
nobody did.
all completely surprised, blindsided by the whole thing.
Us included. So here's the thing that I tell agents, I tell customers, and so forth. Zach does not know what rates are going to do. Chad does not know what rates are going to do. If Zach and Chad knew this, we would have 1 million subscribers on YouTube. We wouldn't have to worry about mortgages, and we would be on Wall Street making hand over fist if we knew what rates were going to do.
I'd be in the Virgin Islands doing it on
True.
Zoom.
you, you, would be with Sam Bankman Fried, right? Over in
That's right.
the
That's
Bahamas
right.
on your laptop. Yeah.
I'd be trying to buy his place at a discount.
Right. So that's what I need everyone to understand. When we make predictions or when we have assumptions or when we think something's going to happen, it's because we are forecasting. That's all we're doing based on data, based on charts, based on behavior, seasonality, inventory, like all these different things. That's what we base it off of. And we have our own experts that we lean on and refer to kind of know, like, all right, this is what we're thinking. Obviously, it's never a guarantee, but here's kind of what we're looking at. And I will share real quick a screen so that you guys can see this because it is interesting. And what's funny here is that a lot of people don't know necessarily what they're looking at. We don't expect you to. It's not your job to, but this just kind of tells us, what things have been doing. So this is when you look, this is a chart for mortgage-backed securities. It's inverse of what you would think in your brain. Most people would go, oh, mortgage-backed securities. Okay, so if this goes down, rates go down. It's inverted. If this is down, rates are up. If this is up, rates are down. Okay, so think of it that way. It's the simplest way to do it. This window here is over the last quarter. So you can, what's great about this little tool here is how you can scroll. I'm doing a MBS highway promotion here. All right. So you can go back and see, and this tells you the dates and whatnot. So this is September 1st right here. So look at where we were September 1. So what this means over on the right in the little black box, it's 101.44. 101.44, gives you an idea on basis points and the change in mortgage-backed security and so forth on this, what's called a candle. And as it slides down, so 101.44 that day, that tells you what the cost of that coupon. So then you come down, 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 look at how bad rates got. And here at the lowest point, October 20th, it's touching 98 and a half at one point that day. Now it bounced back up and then back down, then back up, then back down, and then it's slowly climbed for us. But 98 and a half to 101.44, what that means is that rates got worse from September 1 to October 20 by 300 basis points, right at the doorstep of 300 basis points. So if you're at 300 basis points, that means if the rate on September 1st costs, let's say it was 6.5% and no points, the best way to think of that is 6.5% down the road on October 20th cost 3 points. That's how
Crazy.
much it moved. That's how
Crazy.
much it moved in a 40, what was that? About a 50-day window.
Yep.
Okay. 50-day window. It changed to where it cost 300 or 3 points in order to, in order to make that work.
Well, that was
Um,
September to October. That's 30 days, 40 days.
well, October or September 1 to October 20. So
Okay.
50-day window.
Yeah, 50 days.
Yep.
Yep.
But 3 discount points in
Huh.
order to get the same rate. You literally could have gone under contract September 1, gotten 6.5. Your neighbor goes under contract 50 days later, and all of a sudden you're in a spot where you're getting that same rate, but it costs 3 points. And
Or
so
you go
people,
to 8%.
right.
That
And that's, everybody says, well, I don't have 3 points to pay. Well, that's fine. Then what you would do is take like 7.5 or 7.75 or 8 or whatever it was on that day at par. But that just kind of gives you a better dramatic sense of how much it changed. So rates follow inflation. So as inflation cools and starts to go down, mortgage rates will go down as well. They'll follow suit, or they're supposed to. That's more of the tendencies that we look for. The 10-year Zach is another metric that we look at, and it touched 5% at one point, and that was around the October 20th mark. As of today, which we're recording this on November 22nd, it's at 4.42 as of late morning. So it's trending there. Is this the permanent trend, or is this just a little dip and then is it going to go back up? Like, we don't exactly know. Zach and I have some of the same sentiment though, and kind of the logic on where we can see rates trending and heading into 2024. I'll let you speak on that for a minute.
Well, so some of where we missed things were that the industry was anticipating that reports would reflect certain things. And we kept getting surprised through the late spring and into the summer where we thought we were going to have positive indicators come in. They came in negative. And that kept happening over and over again. We would get surprised by automobile prices and used car prices, and then there would be a revision from 90 days ago to the cost of rent, and there were just all these crazy things, and I became so suspicious of these revisions in the financial reporting because they always put us in a negative direction. It's like, okay, well, everything is there, it's all set, numbers come out tomorrow and where it's going to be better. And then it was worse because there would be a revision to a number that came out 90 or 150 days ago. So the thing that I believe from a kind of a skeptical, but I think realistic perspective is that we will see rates, if somebody said, well, what's the future look like? And I would point very specifically to the election next year and say, we will see better rates at least by then. Maybe there's a natural trend down. Maybe there's a better look at things because there is some control over inflation. Although I would also speculate most of us are not feeling any deflation at the grocery store. We might see it at the gas pump this week, but not certainly not at the grocery store or anything else right now. So we will magically, if not by the forces of the market, we will see a manipulation of data that will result in better interest rates, at least by the election. And that's not a Republican or Democrat thing. It's the present administration. There's a trend there. It's the economy, stupid. That's James Carville's admonition to Bill Clinton way back in the day, and it still holds true. People are going to vote by their pocketbook. And we've got a lot of people who are struggling
Yeah.
around the transfer and sale of real estate that's they're specifically tied to these interest rates. Now, I'm also a believer that when you put the calculator to it, there's not that much of a difference between 7.5 and 6 when you look at the monthly payment, but there's a psychological and mental adjustment that people have not made to these 7.5% rates over 7. So if we can get under 7, and we already saw it, Chad, last week. As these rates improved last week, we saw an uptick in mortgage applications.
Yep.
So that it doesn't. It's a little of a sniff of better interest rates, and this real estate market is going to act up. So that's also why I'm so hot on this idea of prices soaring with low inventory, but we will see buyers come back into this market. And the other thing, Chad, I think that we're going to see a flush of cash out refinances because there's a lot of people
Yeah.
who have gone into higher debt. The consumer debt is as high as it's been because of inflation. So people have spent money up on debt. They spent money up on their credit cards, and we're going to see
Yep.
people tapping into their equity with cash out refinances as soon as these rates come into this zone where we can make sense out of the calculators that we use in our industry about debt consolidation, and maybe you're sacrificing a 4% rate or a 3.5% rate, but you've got these really high interest other debts. We can blend those rates together and make sense out of a refinance at 5.5 or 6. That's a bigger answer than what you're asking for. The
Yeah.
election, we'll get there by the election, maybe sooner by natural conditions.
I agree on that one, and I've had to. You always have to preface it because, unfortunately, our country is extremely divided at the
Yeah,
moment, and
too divided.
this isn't a political show. This is just fact. Whether you're red or blue, when the incumbent in office is rerunning um, for election, like Zach said, you may like it if gas is 50 cents cheaper, $1 cheaper. You may like that milk doesn't cost whatever it is per gallon. You may like the fact that eggs and cheese and grabbing lunch real quick has gone down a couple of bucks here and there. And it does all add up. But the biggest shot in the arm impact will be to mortgages. And
Yeah.
so that's why I think it's the quickest fix. That's why I think if mortgage rates come down, then people either refi, and so then they save two, three, four, $500 a month. 1/3 of all mortgage transactions right now are actually refinances, believe
Which
that
is
or not.
crazy, right?
Yeah, believe that or not. So
Crazy.
don't think you're the only one doing something like that. Like this is the case. Um, that's what's happening in the world right now because you may give up 3% on your mortgage and you may take 7 or 8 or 6 or whatever the rate is that you get for a cash out refi. But in those situations, you're paying off debt that is 22%, 29%, 34%, and it's just eating you alive. And so when you really break it down, it's like, well, the 7% cash out's not as bad as, this 26% Chase card and this 29% Amex card and on and on and on.
The nine
Um,
percent HELOC.
and that's what I was going to say. And the HELOC isn't much relief at the moment.
Right.
So there are a lot of people who need that and want that. But again, mortgage rates are the biggest way to save people money and to show relief and to get people out of debt, or at least reduce their debt, or allow them to quit that
Yeah.
second job, or allow them to not have to cut back on something that would make their life a little easier if they could afford it. Like, those are the things. And so that's why I'm with you. Like, for me, it's all about the election timing. So I've said Q2, Q3 is when I think it starts accelerating, because the election's in Q4, obviously. So I think Q2, Q3 is when it happens. And then you're also leading right into the summertime. So what
Right.
happens then, Zach? Okay, rates are back down. Now people start selling houses again. Now the overall real estate market is ginning again. Now you got people who sell their home and have like tens or hundreds of thousands of dollars in their bank account with equity and cash. And yes, you got to go put that on another house or figure out where you're going to live. But it also gives them the option to immediately go debt free and then still go buy a house somewhere else, and also have money in savings again. So
Which
there's
is one of our strategies in the industry. And to be clear about that, people coming out of these, an equity position of $200,000, and they've got $60,000 worth of consumer debt that they can resolve with those funds, and then put 140 down on the new house. It's a no-brainer because there's so much monthly savings there. So there's a lot of incentive that comes for these buyers who are have a house to sell. Once these rates get down and they've been thinking about doing something, I mean, next summer could be crazy, Chad. It could really
yeah,
be crazy because the kids are out of school. It's time to move. We're going to finally make the move from this state to this state because we want to do something different. And there's so many incentives there if we can get the interest rates right.
100%. So we'll keep that in mind. Future shows, we will actually put up on the screen. I love this exercise. Maybe we'll do it next week and show you hypothetical scenarios on what cash out refinance looks like
Yeah.
and what rates you're actually paying right now. Maybe you do have a 3% mortgage rate, but what if you have $50,000 of credit card debt at 28%? But then you pay that off, and then you consolidate it and how much money you save and what your blended rate is and all these different things. So we have those tools. We'll do those. I really love the whiteboarding type stuff because it's,
Yeah.
again, what we said at the beginning. It's hard to do that in a 60-second reel. It's really hard to get that
Yeah.
message across.
Yeah. Yeah.
So we'll spend some time on doing some of those things, talking about cash outs and so forth. Um, to end the show, though, here on the first one, I like to also have a little comedic relief with at the expense of some of our friends on social media. So Zach and I, here are a few of just the crazy posts, or maybe they're annoying, maybe they're funny, whatever the case may be. This is one that did, honestly, I'll just say it, it pissed me off and it drove me nuts a few weeks ago. We had a good day, a rally on rates, and this one popped up, and somebody says rates went down. We don't call people out by name, by the way. We don't do that. These are just more like, hey, this is, sometimes I know the person, sometimes I have no idea who it is. But rates went down 0.5% today. Never been so happy for a 7.25 rate in my life. All right. So here's the frustration with first is one, they didn't go down 0.5% in a single day. Rates don't move an entire half point in one day. That is extremely, extremely, extremely rare. Like once every 5, 10 year kind of thing. Like it just doesn't move that much. Let
That's
on
not that's
average,
9/11 event rare.
right,
Yeah.
correct. Um, you know, it just doesn't move that much is all I can tell you. Like it would take what, 150 basis point type move. Now the market has been extremely volatile, uh, but still they don't drop a half point in a single day. The tougher part on this is, one, it creates, this is more my frustration with it. It creates this false idea of what's really going on, which then gets people uh I don't know what the best word is. It just starts creating all this unnecessary activity is really what happens, because people start calling us, "Hey, why is your rate not 7.25?" Well, your credit's 640. Why is your rate not this? Wait, why does 7.25 cost a point and a half to get today? Wait, why? What do you mean they're not 7.25? I saw somebody else post this. hey, I locked in already. Can I get that rate? Unfortunately, no. Like you can't. We don't call you when it goes up. You know, you can't always just call you when it goes down. Like there are different rules and parameters and whatnot, but this is just so bland that it actually does more harm than good because it creates frustrating conversations. Because then when we have to tell somebody it didn't really happen, or you don't qualify for that. Like it makes it hard, is all it does. Like it's not it is a positive thing in the sense, hey, rates are going down. That is a good thing. But when you throw a blanket rate out there for the whole market, that's when it's frustrating or sometimes even dangerous.
Well, and it can actually turn people off because they don't feel like they're getting accurate information, or they're getting baited and switched by somebody who's not as is kind of unscrupulous in the way that they're quoting things. Is like, well, I mean, on any given day, I could offer you a 5.5% interest rate if you're
Right.
interested in that. Now it might cost you $47,000 in closing costs to get that, or more. I
Sign
mean, if
here.
this
Sign
is
here.
realistic. This is the absolute truth. You can get any rate that you want to afford, but you may
Yep.
never be able to recoup that money. So it's irresponsible, short-sighted.
And honestly, this is another topic for another day. I think paying discount points is dumb right now. If you want to
It
get my
it
hot
really
take,
is. Yeah,
if you want to get my
not
hot
real
take,
smart. Maybe a little bit of discount point, but not much. It's
I
hard.
think it's dumb. I think
Yeah,
it's dumb. Well, we can talk about that on another episode, but I think discount points are stupid in today's market. All right, let's look at this one. Economists, you know how smart they are, Zach. They
yep,
don't expect trillions of dollars injected with old stimmy money. Remember, we went double stimmy a few years ago.
yeah, yeah.
That wasn't going to create inflation, right? Like, there's no way injecting trillions of dollars into the economy was going to cause inflation.
Couldn't happen. I mean, we're expert economists. No way that printing trillions and trillions of dollars are going to, create an inflationary impact on money supply. But you look at this one. What is that date? July 23rd, 2020. Everybody in the mortgage business was like, man, this has got to stop. We've got to wean ourselves off. This is like, a drunk party on a sailboat. We've got to go back to work. We can't do this anymore. And the Fed, all the chief economists, all the media was saying nothing to worry about, keep moving, nothing to see here. This article was July 23rd of 2020, and I can remember Barry talking about that on MBS Highway, saying this is ridiculous. We are going to have to pay the piper. The hangover is coming.
All I can think about when you say drunk on a sailboat is Will Ferrell and John C. Riley in Boats and Hose.
That's
That's
it,
like
man. That's the
that's
scene,
all that
right?
comes to mind when you say drunk sailboat. Uh, but yes, 100% right. And this last one is my favorite. And guys, we as humans have this problem. We all do. I do to a certain degree. Maybe not Zach because he's perfect, but he doesn't make mistakes. Like, but customers do this. Realtors, you see this, you experience this. Everybody goes through it in some sector of life. Zach and I go through it with online lenders and internet interest rates. Realtors go through it with Open Door and OfferPad and what Zillow will do for you and all these things, right? So this one drives me nuts. But the problem is you want this to be so true, you can't help yourself. Like you want to will it to truth
Right.
because you want it to be true. But unfortunately, it never is. And so I love this one. The These are my favorite. Um, you get the same with Zillow and whatnot. 100 pre-approved leads in 60 days guaranteed. My favorite are the Instagram, Facebook, email targets, phone calls. The phone calls have kind of died down, but hey, if I could get you, do you work with first-time home buyers? Yes. Cool. I've got like 10 of them. I need somewhere to put them. Can you help me out on that?
I can't work them all. I don't have anybody in Tennessee to help me out.
Yeah. Does your team have capacity for an extra 15 leads every month?
Yeah.
No, we hate money. We hate money. We hate successful
I've got
businesses.
leads coming out my ears here. We just can't handle them all. Is there some? Can you help us out? Yeah.
Guys, look, let me just go ahead and break this down for you. In your entire life, has anyone ever walked up to you with no strings attached other than you give them a little money and said, "Here, you give me $100, I'll give you $5,000." Like, no, this doesn't happen. But this is more for all of those genres. Like realtors see this, lenders see this, we get targeted, and then customers. If you're a consumer, you get targeted. How many times do you hear, "Oh, I got this 4.9% interest rate"? Yeah, but what comes with it? Zach just mentioned it. I can give you any rate you want. You want to pay $55,000 for it? There's an ad floating around right now on the internet talking about a 3.99% interest rate. The fact is, it's a 3-2-1 buy down, meaning you start off at 6.99%. Your first year is at 3.99. Your second year is at 4.99. Your third year is at 5.99. Year 4 through 30 is at 6.99. And guess what it costs? About $30,000. So who's going to pay it? So
And that's
those are
on a three
things.
hundred thousand dollar loan. That's
Yeah, yeah, correct. Yeah,
that's on a three
for
hundred
sure,
thousand dollar loan, right?
for sure.
So, yeah.
So it's just more like you see these. The best thing you can do is what we're doing, and that's laugh at it, roll your eyes, and keep scrolling because it just doesn't exist. If it seems too good to be true, generally is the old saying, but it's 100% accurate. So
I think it's accurate for me to say this, Chad, that I have never seen as many lead generation companies and sources in the real estate space on both sides. And I've never seen as much coaching that I've seen
coaching,
that I'm seeing right now. And we've always been an industry that sells a lot of stuff to the practitioners of the craft. But I've
yeah,
never seen as many coaches, and I've never seen as many lead gen services as I've seen in the business right now.
yeah, yeah. It's something is all I can say.
Yeah,
Like it
that
is,
might be a different
man.
show for a different day, Chad.
You, that's an all day just live stream. Follow me around, and I'll just vent
Yeah,
for 8 straight hours.
yeah.
The I got $10,000 worth of coaching for $47 this week only. If you're really into the coaching, check out Black Friday. I'm sure there's going to be even deeper
Ooh,
discounts coming
yeah.
up. Yeah,
Black
which
Friday and Cyber Monday. That's two opportunities to discount
I
my ten
I
thousand dollar package.
the 99.6% discounts off of your service have just never quite
Ooh,
resonated well. Like, all right, makes a lot of sense. All right, guys, thanks for hanging out with us. We try to do these on around an hour schedule, so a little bit over on this first one, but we enjoyed it. Hope you enjoyed it. If anything, it gives us a platform to uh, vent, discuss, soapbox, whatever you may want to call it. But I all of these topics are going to continue. This today's show was not a one and done. Like we're going to be talking about these lawsuits for a while. We're going to be talking about the interest rates and what changes are going to occur here at the end of the year and into 2024 with the election cycle. And again, if you have questions, comments, etc., you see at the bottom of the screen there how to reach out to Zach and myself on social media. We're on Facebook, Instagram, and YouTube. Also, if you drop comments here on this show, then we'd love to respond to those, get back to you, answer questions, or give us topics for an upcoming show as well. Would
Please
love
do.
to interact with you there. So, Zach, thank you. Hope you guys enjoyed it, and we'll see you out there soon and be back next week. Take care.